How credit card debt traps you. A credit card can feel like free money until the bill shows up. And the scary part is not just the money you spent. The scary part is what happens after that. Interest starts growing. Minimum payments make the debt feel manageable. And if you keep using the card, the balance can become harder and harder to escape. Today, we are going to break down how credit card debt traps people with simple numbers, simple visuals, and one golden rule. Understand the price before you borrow. The simple trap. The trap usually starts with one card and one balance. Maybe it is $3,000. Maybe it came from food, clothes, bills, travel, or an emergency. At first, it looks like just one number. But behind that number, there are hidden forces working together. There is the balance. There is the APR. There is interest. There are minimum payments. And sometimes there are new purchases on top of the old debt. A credit card balance becomes dangerous when all of these things start working together. Why it feels easy. Credit cards feel easy because they separate the pleasure from the payment. You buy something today, but you do not fully feel the cost today. You swipe the card, and the purchase is done in seconds. Food, a phone, clothes, a trip, an emergency, it all feels simple. But later, the bill arrives. And now the purchase is not just a purchase anymore. It can become a balance. Then that balance can create interest. Your brain feels the purchase today. Your wallet feels it later.
APR is the price tag. APR means annual percentage rate. In simple words, APR is the price you pay for borrowing money. If you borrow $3,000 on a credit card and your APR is high, carrying that balance can get expensive fast. The higher the APR, the more expensive it is to keep the debt. This is why credit cards can be dangerous. The card does not only ask you to pay back what you spent. If you carry a balance, it also asks you to pay for the time you borrowed the money. That extra cost is interest.
Interest can grow every day. A lot of people think interest appears once a month, but many credit card companies calculate interest daily. That means every day you carry the balance, the card can quietly charge you for it. Day 1, you have debt. Day 2, you have debt plus a little interest. Day 3, more interest. By the end of the month, the balance may have grown even if you didn't buy anything new. This is why time matters. The longer the balance stays, the more time interest has to build. The minimum payment feels safe. Then comes the minimum payment, and this is where many people get stuck. The minimum payment looks helpful because it gives you a small number you can afford. Instead of paying the full balance, you only have to pay a small amount this month. That feels safe. But the minimum payment is usually slow. It keeps the account moving. It helps you avoid missing a payment. But it may not make the debt disappear quickly. The debt is still there. Why the balance refuses to shrink? This is the frustrating part. You make a payment, and the balance goes down a little. But then interest gets added, and the progress feels smaller. It can feel like you are walking up an escalator that is moving down. You are moving, but not fast enough. If the payment is too small, interest can eat up a lot of your progress. So you pay, the balance drops, interest pushes back, and the debt refuses to shrink as fast as you expected. The real trap starts when you keep using the card while still paying off the old balance. Now, you are not fighting one purchase anymore. You are fighting old debt, plus new purchases, plus interest, plus possible fees. And every new purchase makes the problem heavier. This is how a credit card balance can slowly become a bigger problem than the original purchase. It doesn't always happen all at once. It happens quietly, one swipe at a time, 1 month at a time. The way out is not magic. It is boring, but it works. First, stop adding new debt if you can. That means the balance stops getting heavier. Second, pay more than the minimum whenever possible. Even a little extra can help reduce the balance faster. Third, focus on the highest APR balance first, because high-interest debt is the most expensive debt to keep. This is not about being perfect. It is about making the balance smaller before interest has more time to grow.
Minimum versus extra payment. Small changes can change the timeline. If you only pay the minimum, the debt may take a long time to disappear. But if you add extra money to the payment, you can buy back time. Less balance means less interest. Less interest means more of your payment goes toward the actual debt, and that can speed up the payoff. The exact numbers depend on your APR, your balance, your fees, and your payment amount. But the idea is simple. Paying extra helps you escape faster.
Credit cards are tools. Credit cards are not evil. They are tools. Used carefully, they can be useful. They can help with convenience, emergencies, and building credit history. But when you carry a balance, pay only the minimum, and keep spending, the tool can become a trap. The difference is not the plastic card. The difference is whether you understand the price. A credit card is not free money. It is borrowed money. And borrowed money has a cost.
The golden rule. So here is the golden rule. Understand the price before you borrow. If you borrow money, the interest is part of the purchase. That phone is not just the price on the receipt. That trip is not just the price at checkout. That emergency bill is not just the original balance. If the debt stays on the card, the real price can grow over time. Before you swipe, understand what it could cost later.
Sources and disclaimer. This video is for education only. It is not personal financial advice. Credit card costs depend on your APR, your balance, your payment amount, your fees, your grace period, and your card terms. The examples in this video are simplified, but the lesson is real. Credit cards are tools, and the golden rule is simple. Understand the price before you borrow.